Hi, it's John Zlitis. Thanks for tuning in. This is a condensed version of a lecture I gave this week at Columbia University to a graduate level securities analysis course. And the topic for the lecture slash discussion is when you should sell a security. Before we get started, Quo Vadis Capital is a registered investment advisor in the state of New York. This is not investment advice, nor is it an advertisement. Please consult your advisor. Okay, so is there a disciplined way to evaluate when we should be selling a stock? And I'm going to talk about this within the context of a value investing framework. And so I just want to very quickly lay out that we look at value investing as the activity of finding stocks that are trading at a discount to their intrinsic value, which we defined as a company's future earnings and cash flow, discounted for time and risk and adjusted for any particular assets or liabilities that a company may have. When you are managing a portfolio of investments under a value investing approach, the activity is to assemble a series of stocks that you've bought at a discount that have non-correlated risk and success parameters. And then the management component is buying and selling these stocks over time under dynamic market conditions, with an eye to maintaining some of your value approach and also to eliminate mistakes that you may have had. But one real challenge here, especially if you're a value investor, is something where you end up selling the stocks that go up and sticking with the names that have yet to experience a positive catalyst. And if you do that for long enough, what you end up with is a portfolio of garbage, essentially all of the ideas that didn't work. So how do we address this? What way is there to have a disciplined sell structure that continues to maintain an attractive portfolio rather than ending up with a pile of trash? Well, unfortunately, it's complicated and it depends a little bit on your approach. And I do think it's important to stick to some disciplined approach. In this talk, we're going to consider three different approaches or disciplines from an investment standpoint. The first one is cigar butt investing. The second is compounders. And then also we're going to talk about short selling. What's a cigar butt style of investing? This is a style that has been popularized by Warren Buffett. Essentially, there's an analogy that if you were to find a cigar butt lying on the street, it may have a free puff of smoke left in it, and you want to capture that free puff. So you scoop it up. Similarly, you look for a company where the stock has been discarded, but there's some value remaining, and you're looking for an event to release that last puff of smoke so you can sell it at a higher price. In the cigar butt approach, your sell criteria is primarily price driven. And so you're going to sell if the stock that you buy went up and is no longer trading at an attractive discount to its intrinsic value. Or alternatively, when you're wrong, when something goes further south at the business and the company fundamentals deteriorate further, and the idea that you're going to capture some free puff has blown away with the wind, if you will. And then the third reason I would say is like, hey, if you've got a limited amount of capital and you find something that looks even more attractive, you might want to reallocate from one of your ideas. Second strategy we're going to talk about is compounders. And this is a kind of later evolution of Warren Buffett's approach, following a lot of influence from Charlie Munger. And this moves away from finding these very, very cheap names that have been discarded to businesses which can further deploy capital into their existing business, earning a high rate of return. Of course, you still want to buy these at a discount to their intrinsic value, but you're buying a much higher quality business rather than something that is undervalued but also has issues. Now, when would you sell a compounder under a compounder strategy? Well, actually, the idea is you don't want to sell. You want to continue to own those businesses, provided that they are still able to deploy capital back into their business, core business, and earning a high rate of return. However, there will be some cases where we need to sell those. One is extreme overvaluation. So if it's just selling at a price which has become stupid, or it's stupid not to sell at that price, or when you think that their ability to redeploy that capital into their existing business is diminishing, the returns are diminishing, the business has become too large, there's competitive entries. It could be many different reasons why the compounding element of the business is not as attractive as it once was. And so you might not want to own that stock further in that scenario. Along with that, there could be a loss of faith in management. For example, if management were to make an acquisition, deploy some of that excess capital in an area outside of their core competency, or overpay, that would hurt the company's ROIC profile, perhaps trigger a reason to sell. And then lastly, again, if you found something better. Now, I want to call out that among the reasons we just outlined to sell stocks, we did not include, I think, reasons that most people sell stocks. And those might be related to, I guess, macro factors related to the economy, interest rates, geopolitical tensions. This is not a comprehensive list, but I think what I'm trying to point out here is that under the previous two approaches to investing, you really are not using big picture reasons to get in and out of stocks. It's more bottoms up, company specific. All right, so the third way that we're going to talk about selling is short selling. Now, short selling is when you're betting for a stock to go down. And there is something I think is quite different about short selling discipline compared to selling along. And in the case of a short selling discipline, you're really defining your sale relative to external expectations for the business. And in particular, we look for cases where future earnings and cash flows expected by the street are just wrong. So if a company is supposed to earn $3 a share, but we actually think it's worth $1 a share, that would be the number one best reason we could find to short sell a stock. We also look at some of these other characteristics, which I've mentioned here. So now we're going to talk about two names to just illustrate some of the points that we've gone over with here. And the two companies I'm going to talk about are Luckin Coffee and Dutch Brothers, which is also a coffee retailer. Luckin Coffee is a somewhat notorious Chinese business that was involved in fraudulently reporting its revenues. It has since recovered and is making a pretty significant comeback. And Dutch Brothers is a relatively recent IPO, has stores on the West Coast. It's growing quite fast. It sells coffee, energy drinks, espresso-related drinks in a drive-through only format. If we look at the valuations for these businesses, neither is cheap. I put these up against Chipotle, Starbucks, and Yum China because Chipotle and Starbucks are among the most expensive stocks in this particular category. And you can see that Dutch Brothers and Luckin Coffee both trade at higher PE multiples and significantly higher EV to EBITDA multiples. However, I would also point out that Bros trades at a premium to Luckin. Secondly, this is part of the way that we analyze these businesses. We look at return on invested capital, and what you're seeing in these two charts are return on invested capital at the unit level, that is at the individual store level, and at a total company level. And in both cases, Luckin's metrics are superior to those of Dutch Brothers. Their stores are extremely productive and generate very high returns. And the overall business, I would say, is good, a 12% return. Dutch Brothers is not terrible at 10% for the total business, but it's inferior to Luckin on both of these measures. We also like to do what we would call a trend analysis for unit level returns. And in this case, we put up the average store, which is the blue line, and the red store, which are new, recently opened stores for Dutch Brothers versus Luckin. And what you can see from these charts is that return metrics at Dutch Brothers are deteriorating on a sequential basis based on our estimates, whereas Luckin is showing significant improvement on a trend basis. So in summary, if we look at Luckin, this is a unit growth story. It has a very high return on invested capital. It continued to grow. And so I really think that Luckin in this case exemplifies a compounder, a business that can continue to deploy capital into its existing business. And generally, based on the sell criteria that we talked about, this is a stock that you would not want to sell based on the very high level analysis that we just conducted. In contrast, Dutch Brothers also has very fast growth, but its return metrics are slipping a little bit. And what we find is that when return metrics are deteriorating, this tends to correlate with margin compression and deceleration on the bottom line, and most importantly, downward revisions to consensus estimates. As you can recall, we said that estimates being too high was the number one reason that we want to short sell a stock. So in this case, we see downside at Dutch Brothers based on this analysis, especially taking into account the extreme valuation. And this looks like a stock that should be sold, whereas Luckin, again, with this very high level analysis, looks like a long-term compounder that should continue to be owned. So I hope this was interesting. There are more slides, there's more discussion, but I'm going to hold it off here. If you'd like to see the longer deck, please send me a message. And also, I will respond to any questions in the comments. Thanks so much.